Hey traders, Raghee here. Welcome to Market Wrap, and we're going to take a look at the last full session before the half trading day tomorrow, July 3. So Thursday is a half trading day, but Thursday also has a number of major events that we need to be aware of, and it makes for timing on new entries really tricky. Thursday, we've got the non-farm payroll at 8:30 a.m. Eastern, and along with that comes the average hourly earnings, the unemployment rate, the unemployment claims. At 10 a.m., we have the ISM Services PMI, and then 11 a.m., we've got FOMC member Bostic. Now, when we have a day for non-farm, it's an unusual one because it's being released on a Thursday rather than Friday because of the bank holiday. There's oftentimes a little bit of wait and see before such an event, because think about what non-farm payroll can do. And if you're curious about how we factor in macro into the way that I look at the stock market, I'm going to show you the macro decoder ring right now. This is it. This is the CME FedWatch tool. Now, for those of you that are for decades have been looking at the futures contract called the Fed funds, this is a really beautiful and easy to read distillation of the only macro that really matters. Now, hear me out. I'm not saying that other fundamentals and other factors like earnings don't matter. But really, the one thing that I know as a trader that determines whether or not traders have optimism and risk appetite is whether or not the Federal Reserve is dovish, favoring lower rates, or hawkish, favoring higher rates. In this case, we are in a dovish cycle. Even though they haven't cut yet in 2025, the anticipation is that by the time we wrap up this year, the current rate of 4.25% to 4.5% is 46% probability going to be down at 3.5 to 3.75. So this represents still cuts to come. Now, we're not expecting cuts until September. There's going to be a whole lot more clarity at the July meeting, where there is no expectation that's probable for a cut. It's 76% that we're going to hold. It's only 23% that there's going to be a cut. So when I'm talking probability, I'm talking, what do the numbers say? What's the data say? Not my gut, not some talking head on television. What is most probable? If the jobs numbers continue to head lower, right now we know that we can look at non-farm payroll as part of that. I'll also look at numbers like the JOLTS. Today we got the ADP number, which was a big miss. And when those types of things happen, the messaging to the Fed from the market is your monetary policy is affecting jobs. And if that's the case, we need to consider cutting sooner or more than expected. So this is that whole saying of bad news is bullish. We're a little bit in that environment. Bad news in this case should put, bad news meaning the ADP, should put a little bit of pressure on the Federal Reserve, but really the main number is going to be that non-farm payroll. Number two to non-farm payroll in terms of the importance of jobs data is the JOLTS, or the job openings number. So we'll find more out about this 8:30 tomorrow. And I'll retake a look at what the expectations are for rate cuts. It's good to know what they are a day in advance. Where are we now, so we can compare and contrast after the data comes out tomorrow. As far as what we're looking at in the Sector Secrets Mastery, the macro that has been in place since early last year has had me bullish. I haven't deviated from the bullish approach at all. So I want to share a couple other things that we're doing in the Mastery aside from, the swing trading. One of the most popular sessions that we have in the Sector Secrets Mastery, so we have a day trading session, we've got the swing trading session, the Lorna bot, as we endearingly call her, has a bot scalping session. But the session that's really grabbed a lot of the imagination of traders and made them realize that time is a powerful asset to a trader. In a world of 0 days to expiration and day trading and faster, what happens if we take the other side of those expectations, right? And that's where a lot of traders are discovering that giving trades time on a longer term time frame is really powerful. The first Tuesday of every month, we do our long-term growth session. In fact, it's fresh in my mind because we just did it yesterday. And I'll show you a couple examples from that. But none more dramatic than understanding what happens over time when certain indices like the S&P pull back 20%. And then you say, you know what? I'm going to hold on tight and I'm going to give it time. And this was a setup, an alert for our long-term growth part of the Sector Secrets Mastery, where we scooped these things up, the SPY. Some of our members bought leaps, but everyone else stepped in at about 490, I think it was 490.58. That was where the 20% sell-off in the ES actually equated to the SPY buy. And then we sit tight. Then we do nothing. Then we think in terms of months and years, right? And not in terms of days and weeks. In fact, there's this really cool image that I saw, and I don't know whose this is. I'll find out so I can credit them, but it's just a really simple idea. If given days, we could definitely have volatility, both up and down. And if given months, we can see gradual movement, perhaps to the upside, especially in the sort of favorable, dovish macro environment that we have right now. Give something years, and we can really start to see examples of overall macro favoring, supporting stocks after massive sell-offs. And again, if you disagree with the Federal Reserve, gang, we don't get brownie points as traders for disagreeing with monetary policy or debating the debt, right? A lot of traders get caught up in that and they miss what's actually happening. If you give things months, obviously you can see even more growth. So let me give you an example of another trade that we took, and this was back in Q3 of 2022. And actually you can see here with the highlight, so when I talk about long-term growth, I want everyone to see that as much as I love swing trades, and I'll recap some of the swings we've got going on, we bought XLK back here, Q3 of 2022. That's where we are right now. And this is the benefit of having years. Yeah, there's going to be little moves to the downside, sometimes larger, sometimes really large. But if this is where you're digging your heels in, does a pullback from 240 to 180 shake you out? Oh gosh, no, it still represents almost a 60-point profit per share, right? So as much as it's fun to talk about swing trades and what we can do in 2 to 10 days, clearly I want to make sure everyone sees what the longer term can do as well. A really, again, ridiculous example, but it happens from time to time. Those 20% pullbacks in the SPY, we endearingly call that the Auntie Raghee strategy because I taught one of my nephews back when he was in middle school. He's of the age now where he's graduated college and he's looking to buy a house. Guess what he's going to do that with? His 20% pullback buys in the S&P. Now, let's fast forward to where we are right now, because a recap means, hey, what are you doing in the mastery? I didn't have any day trades today. It's been kind of dry on the day trading. I don't like the structure. I don't like the risk. And so we've been focusing on the swings. The other day I mentioned we got into Mondelez. And yesterday, Mondelez had a really nice rally, and we scaled out at our T1. We've moved to break even. And here's a really cool thing about new highs. Anytime I have new highs, I am going to look for more participation from retail to the upside, because after a move like Mondelez had, taking out the high of June 23 at that 68.80 level, it gets talked about. It lands on a lot of momentum traders' radar. Now, we're going to play the pre-momentum. The best way I know to play pre-momentum is to use the Darvis box. And that's why we bought the support area down in here, because Darvis typically is a pattern of momentum. Most Darvis traders will use the breakout, but if the breakout is probable, why not buy the oversold support? That's exactly what we did. So Mondelez upward and onward. Here's another cool example of being patient. Yesterday in Barrick, right at the open, we hit our first target, and that was pretty much this high. We were there for probably 120 seconds, no exaggeration. Right on the bell, 2 minutes, we hovered in that area. For traders who get my alerts, they're going to see that in the original alert, we have a 2120 exit. So they're not waiting for me to tell them to get out. They know the number. But even knowing the number, sometimes things pull back. Well, the instruction I gave our traders is let's move to break even and wait for another shot at that 21.20. And that's exactly what we've got. So this is where I put that risk management first and foremost. Not how much money do we make? What percentage was it? Nothing like that. A lot of traders kind of parade around like DJ Khaled. All I do is win. Look, I win enough, but I win because I take care of risk. So yesterday, I wasn't able to scale out of Barrick at the price I wanted. So I took a breath. I looked at the structure. I realized that I'm not down on the trade, that the previous trend was up. The candles that indicate much more bullish trend, momentum, and participation suggest that I should get some higher highs or at least a revisit to 21.20. We finally got that opportunity the day after moving to break even, making sure we cover that risk. No one here listening to a market wrap show hates their money, is thinking about pie in the sky, let's grab the hot stock kind of thing. It's really not about that. I know it can be fun when we grab a stock that really gets moving, but I'm usually doing that in very stable names. I'm not playing IPOs. I'm not playing meme stocks. I'm trying to stick to where lists are going to retain the attention and the dollars and basically the continuation, so we can see a trade continue. Hood last month would be a great example of that, and it continues to be a great performer. So that brings me to a couple places that we're looking at right now in the mastery, and that is in the FFTY and in the Buzz ETF. So if you haven't taken a look at either one of those, please do. This is where social sentiment, all of that conversation that's happening in the market, stocks that maybe are not meme stocks, but are exhibiting that very momentum-driven meme behavior, they're going to be in this group. They're going to be in BUZZ. And take a look at Coin, Rocket Lab, Robinhood, etc. You have a lot of names here. Wherever we have the green trend, that's where I want my focus to be. And these are names that we're looking at in the mastery, as well as some of the names in the FFTY. This is the IBD Innovator 50 list. And once again, I'll do the same thing. What are those names that are benefiting from overall bullish momentum that I can buy on a pullback? Two of the newer trades that we've got right now are CCJ and URA. And while they had a pretty bearish after hours, I'm not going to get caught up in what happens in some of the thinly traded after hours. CCJ, URA back right up on their bullish ways after hitting some lows. And these are two of the newer positions that we've got in the mastery right now. Ultimately, because of non-farm payroll, I want to be really patient and probably a little bit more measured about putting in more trades. There were a couple setups in CRWV, in PANW, in IBM. Those are names that we're watching that were pretty close, if not at levels. But the challenge is this. Tomorrow at 8:30 a.m., a full hour before the bell rings, we're going to get non-farm payroll. The thought process is not how much money could I make if I'm in those names, but if things turn around based on whatever that NFP number is, and I'm dealing with maybe a gap open against my position, I don't want to put a bunch of disproportionate risk on the table before an event like that. Now, that said, we're far from flat. At the moment, we have 6 open swings in the mastery, including that aforementioned CCJ and URA. We're managing profits after reaching T1 in RTX and Barrick Gold and in Mondelez. So it's not that we're flat, but what I'm trying to remember is I want the kind of stocks that may not be as sensitive to risk appetite or risk aversion, right? They might have narratives all of their own, and that's where we're basically at. Mondelez is the best performer in the staples. Barrick Gold is one of the better outperformers in the gold miners. Newmont Mining is another one to keep in mind, as would metals and mining. You're probably going to hear me talk a lot about metals and mining. This was a very good sector to us in June, and I fully expect to get back into some of these names Even Freeport Mac we're in here in July. So again, these are on our list. Our list does not change every day. It evolves. Some names get added, while others that might be losing that bullishness and those characteristics that I like to see, they may get dropped. But ultimately, what I'm looking to do is focus on where the continuation is favoring not just the bullish candles, but a bullish trend. So that's where we are right now. 6 open positions going into non-farm payroll. I could have easily probably had 9, but it's really a matter of, do I want that risk in front of a half-day non-farm payroll holiday affected week? Or as a trend trader like myself truly believes, healthy trends pull back. I'll get another shot at it. It's always about managing risk first, and that's exactly what we're doing. So half of our book at this point is at protective stops because we've already hit the first target, and the other half of the book, the other 3 positions, are moving in our favor but haven't yet. So those are the ones that I would say are in harm's way. So rather than loading up more positions like that, we're going to be patient. July has just begun. It's off to a great start. Onward and